Hi everybody, this is Ellman, the Blue Collar Investor. I'm here today to discuss our option premiums and what they may tell us about our underlying stocks. In June of 2009, I wrote an article entitled The Greeks, Factors That Influence Our Option Premiums. One of those factors is called Vega. Vega has to do with volatility sensitivity. The more volatile a stock, the higher the option premium. Now that makes sense, because we as option sellers are incurring more risk with a volatile stock, so we want to be paid more. The option buyer has an opportunity to make a lot more money, so he's willing to pay more. So with that in mind, I want to tell you a story about a lesson I learned many years ago, and I discussed this in my first book, Cashing In on Covered Calls, when I looked at a stock called Taser, a company that produces stun guns. And I took a look at the option return on Taser and saw that I can generate a monthly return of 8% on this stock. Now, that had a lot to do with the Vega, or the volatility of the stock, because at the time, the police were testing the Tasers, and some of the reports came out favorable, others unfavorable, and the stock was going way up and way down. It was quite volatile. And that's the reason the option premium was so high. But I fell prey to this. I bought way too many shares of Taser, and I started selling the premiums. And of course I was generating my 8% as I watched Taser go from $33 a share down to $8 a share. I learned a hard lesson. So now I want to bring you up to date with a stock that's actually on my watch list right now. The ticker symbol is FUQI. Now it meets all our system criteria, and I started to do the calculations. Now for purposes of reference, we're at the end of the June contracts 2009 and 2 days away from the beginning of the July contracts. So the calculations I'm about to give you are for the full month. Currently, the stock is trading at $17.63 a share. So normally what we do is we go to the nearest strike price, the $17.50, slightly in the money. Pretty much we consider it an at the money. So the calculations went like this. If we sold the contract of the $17.50, we get a return of $1.90 per share, $190 per contract. We'll deduct the $13 in the money, and that gives us a return of 10.1% for 1 month, or 121% annualized. Now right away, rather than jumping for joy, I became concerned, because I knew that Vega was rearing its ugly head, and we had a stock that the market is anticipating to be very volatile. I checked to see if there was an upcoming earnings report, because that could account for some volatility, and there was not. So why was this stock considered so volatile? Well, the best I can come up with was the chart pattern. This particular company had run up dramatically in the last 2 months since April, and I'm going to hold up a chart to show you. Okay, you could see that since April, FUQI has gone from about $4 a share up to about $17 a share. And my belief is that the market is anticipating a drop back. So the question remains is, do you want to grab that 10% and hope for the best, or do you want to be more conservative? Now, being more conservative means either to pass it by, or perhaps to look at a lower strike price to get some downside protection. So that's what I did. I figured, let me check out the $15 call and see how that plays out. Well, the $15 call was selling for $3.30. We need to deduct the intrinsic value, or the amount that the strike is in the money, which is $263, from the $3.30, and divide it by the bought down value of the stock, which is $15, or the strike price. Those of you not familiar with my calculations, I had devoted an entire chapter to that in my first book, Cashing In on Covered Calls. That calculation comes out to a 1 month return of 4.5%, a beautiful return. But there's more. We also have significant downside protection, because that stock can drop from $17.63 all the way down to the strike price, and we have still preserved our 4.5% return. The calculation is as follows. We take 263 and divide it by 1763, the current market value of the stock, and that comes out to 15%. So what this all means is that We are guaranteed a 1-month return of 4.5% as long as our shares do not depreciate in value by more than 15% in this particular contract cycle. So everything really depends on your risk tolerance. If you're more of a gambling type of investor, then you might go for the 1750 call, or you might even go for the $20 strike. But the two major choices that most would consider would be the 1750, or if you're more conservative and capital preservation is critical to you, then you'll go for the $15 strike. The main point that I want to bring out to you in this video is that oftentimes an option premium can tell you a little bit about how the market is perceiving the underlying stock, and we want to factor that into our investment decisions. So I hope you found this video helpful. I look forward to hearing from you, and thanks for taking the time to view this video. Take care, everybody.